What's up everyone? Welcome to Investing by the Numbers. Today we're going to cover the one Canadian undervalued dividend stock that I've been buying here in late May. The market has really been running up and I don't see a lot of deals out there, but this stock is still undervalued. It's been really beaten down, but right now it's paying a 5% dividend yield. In my view, that dividend is safe for the long term. Plus, this company has tremendous long-term growth and I believe will outperform its competitors. So stay tuned and I'm going to deep dive on this stock for you. Okay, so the stock that I've been buying recently is NTR, and that is Nutrien, okay? So this is a company that has really great long-term potential. They are the largest producer of potash in the world, which is one of the key components for fertilizer. And come check in over my shoulder and I'm going to show you exactly why I think this is a great value buy right now. We can see here that they pay out currently a 5.5% dividend yield. I'm recording this on the night of May 26 and the current price is $46. And that is in Canadian dollars. This is a dual listed stock, so you can find this on the New York Stock Exchange as well under US dollar pricing. And this is a company that actually was created in 2018, the very beginning of 2018. So everything prior to it doesn't really matter. That's more to do with Agrium and a Saskatchewan Potash Corporation. But it's from 2018 onward that we're concerned about. And we can see here that they've been kind of living in the low 60s to mid 70s range. And they had a tougher year in 2019. And I'll explain a few reasons why for that. And then, of course, we had the big crash here in March from the COVID. And that brings us all the way up to date here at $46. So if you've seen my videos before, you know I like to do a simple analysis that includes 8 points, and I give it a score of great, good, fair, or poor, and Nutrien gets a 24.5 out of 36. Basically, I'm just giving 4 points for a great, and so on down to poor. And I'll review each of these for you to discuss why I think Nutrien is undervalued right now. So we can see here that in 2019, the payout ratio was 77%. And that is, of course, based on the net income. And I also like to use the payout ratio based on the free cash flow. And if we do the math on that, and that's a simple calculation by taking the total dividends per share paid and the number of shares, multiplying that together and then dividing it by the free cash flow, we get 58%, which is great. And to check the dividend history, we're going to have to look at Agrium, which was the company that merged with the Saskatchewan Potash Corporation. And we can see here that over the past 6 or 7 years, they've been paying out a consistent dividend, which is good. And going back to our Morningstar financials, we can see that they've raised the dividend a little bit since they first started in 2018. And checking the insider holdings, we can see that they're pretty weak generally. The president here, Charles McGraw, who used to run Agrium, and a few of the other guys have, a decent little chunk, but it's not anything compared to what they get paid in a single year. So that's not too enticing there. And checking the board of directors, we see kind of a similar story. No one seems to have a massive stake. It's pretty much the CEO and a couple other guys like this guy, Aaron Regent, who owns 1.1 million worth of shares. One very bright spot for the insider holdings, however, is that 2.5 million worth of shares have been bought in the last 3 months, and that is a real vote of confidence going into this challenging situation. And similarly, another 1.9 million was bought in the last 3 to 6 months, and after a tough year in 2019, that's again a vote of confidence by management, so that's a huge positive for the insider holdings. Okay guys, before continuing, please smash that like button if you're enjoying it and getting value so far. I really appreciate your support. It really helps out the channel, so thank you. And we can see here that their revenue has grown a little bit since their merger in 2018. And similarly, their book value is fairly strong. They have a book value right now of $54. Of course, the share price is at $46. That doesn't mean too much, but it's an idea that it might be undervalued. And we can take a look at their net income in the past couple of years here since the merger. And this number in 2018 was primarily because of a one-time change for the accounting measures during the merger, and that's not ever going to be that way again. And so 2019 is our first kind of clear year, and they have a net income of 992 million. So based on revenue of 20 billion, their profit margin was only about 5%, their net income rather, and that's something we're going to explore in a minute here. And as far as the economic moat goes, Nutrien possesses a narrow economic moat according to Morningstar, and I would have to agree with that. It's basically based on their cost advantage in potash and nitrogen, and it's partly because of their size, but it's also partly because their operations produce potash and nitrogen at a lower cost as compared to their competitors. And using simply Wall Street to take a 40,000-foot snapshot of their financial health, we can see that they have a net assets position of about 24 billion, and they have about 14 billion in debt, as well as 3.2 billion in cash and short-term investments. And we can see here that Nutrien also raised 1.5 billion in debt recently, broken down into three groups of 500 million each, and those are at very low interest rates, with a 1.9% interest rate on their 3-year note and a 2.9% interest rate on the 10-year, and then they have a 30-year note as well at 3.95%. So they're in a great financial position. They have lots of cash and should easily be able to pay their dividend. And they also, when we take a look at the earnings per share here, it's a little bit difficult to decipher since their earnings per share were jacked up due to that one-time accounting change from the merger. And we only really have this 2019 earnings per share to look at. One thing we can say is that in the last year, they've purchased a lot of shares. So they did some share buybacks with their free cash, which is, of course, very positive for existing shareholders. And the final metric I like to look at is the return on invested capital. And I'm going to use the older numbers here from Agrium to get a bit of a sense of what's going on, since we really only have that 1 year where things got adjusted massively in the merger, and then the more recent year in 2019 where they've had a tougher year. But overall, over the past 10 years, this company, which is including Agrium, not necessarily Nutrien, but has done very well with its return on invested capital. And so I'm going to use some of those numbers to, give me guidance for how they may fare in the future. So Nutrien recently released their quarterly results, and this is some highlights from what was going on in the most recent quarter. And you can see here they have had a bit of a tough time and that's run on from another difficult time in 2019. And this is primarily because prices of potash and nitrogen are low right now. So this is a company, just like oil companies, where a lot of their success is dependent on the price of the commodities that they sell. And in the first quarter, potash EBITDA, so basically their earnings, their profit, was 38% lower than the same period in 2019 due to lowered net realized selling prices. And so that is just the price of potash, essentially. Same thing with nitrogen, 14% lower. And they also comment here on their ability to pay their dividend, which they basically say it's very stable because they have strong retail earnings. So Nutrien is not just a producer of potash and nitrogen, but they also have a huge network of retail stores in North America, some in South America as well, and they sell a lot of their own private labeled products through those stores. They're also expanding their online presence so that farmers can buy direct online. So they're doing a lot of things that allow them to make profits in various ways aside from just selling bulk quantities of commodities. And we can see here that they've lowered their guidance for the year, which essentially means they're going to plan on making less money, which may not sound good if you're wanting to invest, but we have to keep the long term in mind. And a lot of this, of course, is already factored into the price. The potash and nitrogen, these are basically inputs for agriculture, and that's not going anywhere. Despite COVID, it's an absolute necessity, and they are an essential business. So they've still been trucking along. Of course, their biggest challenge has been basically the prices of these commodities. So this graph gives us a little picture of what prices are like for the potash and nitrogen components of their business. And in 2019, they were below the 10-year average significantly by about $80 per metric ton. and also similarly over here in the nitrogen side of things, $75 per metric ton below the average. Now, prices in 2020 have dropped a little bit since then on both of these fronts, but this just gives you an idea that on average, generally speaking, this is a cyclical business, and eventually prices will come back up as many of the businesses decide to slow down their production in order to support prices and ensure that their bottom line doesn't erode. And we can see here that sales in the first 3 months of 2020 have actually been stronger than compared to the 3 months of 2019. So their overall revenues have been growing. They've just been having challenges due to profit margins. So another key point for Nutrien is that they are a globally integrated company, and that means essentially that they are doing not only wholesale of commodities like their nitrogen and their potash, but also they have their own retail stores. So they have a huge network of retail stores throughout North America and are also growing their digital side of their business. And the retail stores really allow them to have much more stable revenues and profits as compared to other companies in the industry that are just pure commodity plays in the fertilizer business. Another thing to mention is that currently they have 600 million metric tons of available potash capacity that they are not using, and these are from low-cost mines. And the thing is that they are trying to minimize their production a little bit like other players because prices remain low at the moment. And this graph here shows us that the retail margins have been continuing to grow, and this is partly because of the proprietary products that they are creating and the great network that they have of stores in North America. And Nutrien is also trying to acquire other stores, as I mentioned, and so they're going to be growing their global retail footprint by acquiring other smaller businesses, and this just adds to their stable cash flows, which again allows them to outperform other players in the market who are just pure commodity players. Morningstar does a fantastic analysis on this company, which we'll review quickly here. I'll show you the highlights. And they also believe that this company is undervalued at the moment. This little temperature thing that they do here, they give it a 5-star rating currently at this price. So it's something where they believe it's undervalued. They believe that the management is exemplary. I like that word. And the economic moat, as I mentioned before, is narrow and stable. So the first thing I'll highlight is the long-term price forecast that Morningstar has for potash of $310 per metric ton, and currently the 2020 price is probably around $220 per metric ton. So that's about a 40% difference. And again, this is like an oil company when prices of oil are at $30 a barrel versus when they're at $45 or $50 a barrel. That makes a huge difference to the underlying profit of that company. And Nutrien is no different. The major difference, however, is that Nutrien is also selling through the retail stores. They're selling to farmers, and they have proprietary products, over 150 proprietary products that they sell to farmers. And so they have much better and more stable margins on that, as opposed to just selling large-scale potash or nitrogen, these inputs for fertilizer. And as I mentioned before, the nitrogen and potash mines sit on the low end of the global cost curve, which essentially means they can continue to have okay profits when prices are low and really high profits when prices return to higher levels. So this is true for the potash and the nitrogen portions of their business. And for nitrogen, one of the biggest inputs is natural gas, and natural gas is quite cheap in North America where most of their operations reside, so it allows them, again, just to be on that lower end of the cost curve. And the other big input for fertilizer is phosphate, and this is a part of their business that doesn't do so well. They're kind of in the middle of the cost curve. And before the merger, the Potash Corporation of Saskatchewan completed an upgrade to a low-cost potash mine. So they optimized that asset, and Nutrien is likely to undergo a similar scenario with their Agrium assets, and then that way they're going to continue to lower their costs. So I'm hammering on this, but it's basically, again, very similar to oil, where the companies that have the ability to produce at the lowest rates tend to have the best times during more difficult times, and then other companies are struggling, they have to slow down or maybe won't survive. And when that happens, prices eventually go back up, and then these companies prosper. So what happens when prices are low is that companies like Nutrien, they start to reduce their production, and other companies tend to follow suit. This German potash producer, K plus S, I guess their SDF is their symbol, and also another one, Mosaic, which is an American company. And so what happens is all of these producers start to reduce their production, and eventually prices will rise. Okay, so I just want to wrap up for NTR here and summarize what we've learned. Essentially, this is a company that has a global footprint. They're in Australia, they're in South America, but largely their operations in North America. They have a huge retail network, and the retail profits are quite high, in part because they're constantly producing more and more proprietary products, which means they have the full value chain, okay? They're producing the ingredients, and then they produce the product, and then they sell it. So they are making money all the way through in the retail sector. So that allows them to make profits during difficult times when commodity prices are lower for things like nitrogen and phosphate and potash, which are the core components of fertilizer which they make. And so this is a company that you want to be buying it when commodity prices are low and there's negative pressure on the whole industry. And this is because we want to buy low and sell high. By the time the commodity prices rise, that's when they're going to start capitalizing on serious profits, and the market is going to drive the stock price up. So you want to buy low, sell high. In my opinion, it's undervalued right now. Commodity prices should come back up in time. Again, we're long-term buy and hold here, but if you are going to buy it and sell it, if you are going to trade it over the course of even 3 or 4 years, a much longer timeline, you want to buy when commodity prices are low and sell when commodity prices are high and they've realized substantial profits. So that's a wrap for NTR. Stay tuned, because I'm going to share with you part 2 of this series where we look at undervalued Canadian dividend stocks. And while NTR is a stock that is quite stable and I think is going to easily pay its dividend, this next one that I'm going to cover has huge upside potential. It's also a little bit more risky, but it's one that I'm keeping my eye on and I'm going to jump on when the opportunity is right. So check that out, and we'll see you next time.